Good morning, everyone.
Good morning, sir.
Good morning, sir.
Good
Yesterday's
morning, sir.
tax class, I had to stop abruptly because we had some important meeting. I think MB Patil sir has informed you about that all of a sudden we were called for a meeting, and that's the reason I had to abruptly leave your class. Anyways, today we'll continue. Today we have investment management class, and then we have tax management class. So we'll continue with investment management right now, and then we will shift to the tax class in the last session. Okay. So just to revise as to where we had stopped. Okay. I think we stopped at this particular slide. Is it clear? I think we stopped at this particular slide.
Yes, sir. Yes, sir.
Yeah. So now we move on from where we had stopped. I'll just revise what we have just discussed. We estimated in the last class, we estimated how to compute beta. It was nothing but a simple regression equation that we have understood. The formula is well versed with you. You know this particular formula. Okay. So by using this particular regression analysis, we find out the first parameter, that is beta. And when we find out the first parameter beta, we replace this particular parameter beta in this particular simple regression equation, and then we arrive at the value of alpha. Now what is y bar? Y bar is nothing but the mean of the average of your stock returns, and x is nothing but the average of your index return. I told you that I will show you a live example also by using this particular data. These are the inference points as far as beta is concerned. So as I said, beta indicates that it is a slope of the characteristic regression line. Now, what is characteristic regression line? I'll just go back one slide. This is your characteristic regression line. If you remove this E, if you eliminate this E, it is as good as alpha is equal to beta into Rm. Okay. The same is applicable here. Alpha is equal to beta. Alpha is equal to there is one parameter called y bar minus bx. So it is just a replacement of equation here and there. Okay, and then you will be able to get the required parameter of beta and the required parameter of alpha. Now, what does this indicate? It indicates that these are the inferences. It indicates how is your individual stock related to the overall market. Okay, how is your individual stock related to the overall market? If you want to know this, you have to estimate a parameter called as beta, and if your beta value is in between these particular range, these are the inferences that you can draw. I'll just summarize it once. If beta is equal to 1, which indicates that your stock is moving in accordance with the index return. If your beta is less than 1, that means your stock is less volatile. Always remember, whenever markets are falling, you need to have shares in your account wherein the beta value is less than 1, because if the market falls up by 1%, your share is going to fall less than 1%. On the other hand, when you are in a bull run, when the markets are going up, it is always better that you have shares in your account whose beta value is more than 1. The reason is, if market goes up by 1%, your stock will go up more than 1%. Always remember, you have come into stock markets to earn money, not to give money. So you should focus on the return that you are going to get. On the other hand, a very rare phenomena that we can observe is that beta value is negative, which means there is no relation with the index. In other words, if the market goes up, your share is going to go down, right? So there is an inverse relationship between your share and the stock markets or the overall markets. Conversely, which means if the markets are going down, you are the only company or you are the only shareholder whose shares are going up. So this phenomena is a very rare phenomena that we can observe, but yes, we can experience such phenomena, especially in turbulent times. Okay, turbulent times means when markets are not stable, when there is a itchy movement in the market, that time we can experience such beta values which come to negative. Okay, I'm going to take this example of Bajaj Auto and NSE index. Now, in my case, Bajaj Auto is nothing but Y. Bajaj Auto is nothing but Y, and NSE index is nothing but X. Are you able to understand? So my Y will always be my stock and my X will always be my index. So this is how we are going to estimate the value of beta. Is it clear? I'll come to the Excel sheet and then I'll interpret how do we compute value of beta. Now, in the previous slide, I told you in a text format as to how the beta values indicate. I also remember that I showed you that this is a 45 degrees angle that is created, and whenever a 45 degrees angle is created, beta value will generally be equal to 1. Next, if this is a 60 degrees angle that is created, then beta value is greater than 1, which means markets are very, that means there is a high volatility that can be experienced in your stock. On the other hand, if this angle is a 60 degrees angle, which means your beta value is less than 1. Okay, so we have three phases. One is beta greater than, one is beta equal to 1 is beta greater than 1 is beta less than 1. And if you observe all this, these lines, okay, these slant lines that you see, they don't start from 0, they start from a particular height on on y axis. It is because this height, okay, this parameter we call it as an alpha value, or this is what we call as an intercept. Intercept is nothing but it is a point wherein the slant line cuts the y axis. I repeat, intercept is a point on x axis or on y axis. In our case, it is on y axis. Intercept is a point on the y axis wherein the slant line cuts or joins that particular vertical line. That is a point wherein we can say it is a regression line. In plain and simple words, it says that whenever you invest your money, you don't suddenly jump into the stock markets. What do you do first? You first invest your money into very, very safe instruments. That is how you need to go about, which means you keep a fixed deposit. If you keep a fixed deposit, generally what is the rate of interest that you get? Let us say you get around 5%, or let us say you get around 6% as rate of interest. So 6% of rate of interest is you earn without doing anything, without taking much of problem, without being in, without taking any risk. You can easily earn around 6%. So what does it mean? It says that people who do not want to take risk can at least earn 6%. So this line, can you see here, 0 to this particular point? I want somebody to respond. Can you see this point from 0 to this particular point?
Yes, sir.
So this point says that there is no risk up to this level. That means if I keep money in fixed deposits, at least I will get around 5 to 6% without taking any risk. But if I want more returns from that, then I have to start taking risk. This is a risk line and this is a return line. This is a risk line, this is a return line. So if I have to start taking, if I want more returns, I should start taking more and more risk. The more risk I take, the more returns I will get, but it will come at a price. So here so here alpha indicates the intercept. Intercept is nothing but it is a point wherein you can expect the least amount of return from the market. If you want more return, you should be ready to take higher amount of risk. That is what this particular slide talks about. Any doubts in this?
No, sir.
Next. Now, we have estimated the beta, we have estimated the alpha from the previous slide. Now we need to take into consideration what is the correlation between them. I think you have studied correlation.
Yes, sir.
You know this particular formula of correlation?
Yes, sir. We have the same in the statistics.
Right. So correlation formula, wherever you go, the formula remains the same. Because what are you doing? You are trying to find out how is one value related to the other. That is what you are going to find out in the correlation. And I also told you about a concept called as R square, which is nothing but coefficient of determination. Okay. Now, I'm not going to go into the details of what is a coefficient of determination. We'll directly go to the problem and then we'll try to understand how do we compute all this data. Is that okay?
Yes.
Okay. Now, so we have seen what are the different types of returns that we get. We get an average return, we get an arithmetic return, we get a geometric return, we get a return relative, we get an absolute return. All these are different types of returns. And we have seen various types of risk. We have seen what do you mean by standard deviation, what do you mean by variance, what do you mean by alpha, what do you mean by beta. All these are nothing but calculations related to risk, and we have seen some calculations related to returns. Now we need to have a relationship between, we need to always take into consideration the returns also, and we also have to take into consideration the risk also. So whenever we have to combine these two, we have to find out what is our expected return and what is our expected risk. So to find out what is the expected return, this is the formula. I want you to make a note of this. Okay, expected return is equal to ER is equal to summation of individual returns into their probabilities. Please understand this. ER is nothing but expected return is equal to, this is a summation sign, okay, summation sign into RI. RI is, you might have 10 returns, you might have 20 returns, you might have 30 returns, you might have 40 returns. So up to I value, we don't know what is that I value. So up to N, you might have returns, and you will have probabilities also for that. So you just multiply the probability into that particular return and keep on adding it, you will get your expected return. Same is the case with standard deviation. I think this formula is very similar to one that you have already seen here. I'm just going back for you to make yourself comfortable. Yeah, the formula that you can see here, the same formula is applicable here. The same formula is applicable here. There is no change, only the difference is the way it is been written. It might, you might feel that it's a different formula, but it is not a different formula, it's the same formula. Is that okay? Anyway, just make a note of these two formulas.
So,
Yes.
so standard deviation is always just sigma, right? Here it is sigma raised to 2.
What happened?
So standard deviation is always denoted as sigma, no? Here it is sigma raised to 2, sir.
Found out the correct mistake. I have to. By the way, this is a square root. Huh?
Yes, sir.
Who is that? Done? Have you noted the formula?
Yes, sir.
Now, let us try to find out a simple problem, and I want you to solve this. I will give you a hint. Please solve it. Here, please understand, the word probability is given. Means what? Here the word probability is given. Means what? You are calculating the return, or for that matter risk, for the future. Whenever probabilities are given, you are always calculating risk and return for the future. So here I have 3 probabilities, and I can expect either 4% return in security A, 2% return in security B, or 0% return in security A. What does it mean? In simple words, this problem tells you, has asked you, you are supposed to calculate the return of security A and B with the following data. So what does it say? There is a 50% chance, there is a 50% chance or a 50% probability that I will have a return of 4%. There is a 40% chance that I will have a return of 22%. And there is a 10% chance that I will have a return of 0%. Right? This is the question that has been asked. Same is the case with security B. There is a 50% chance that I will have a return of 0. There is a 40% chance that I will have a return of 3. And there is a 10% chance that I will also have a return of 3. Now with this data, give your security of preference based on risk and return. You are supposed to calculate the risk and you're supposed to calculate the returns. What formula will you use for calculating risk and return? You are going to use this formula. You are going to calculate expected return and you are going to calculate expected standard deviation. This calculation is for return. This calculation is for risk. Now you have to calculate risk and return and tell me which security is better. Is security A better or is security B better? Can you do it? I'll help you out. Okay, I'll just help you out. First of all, what you will do, you will write expected return. You want me to solve this or how is it?
Yes, sir.
You want me to solve it? Okay. Let's try to solve this particular. So I'll just solve this. I'll first take these two parameters. I'll take these two parameters. Okay. Can I calculate expected return of A? This is not RA, this is expected return. Can I calculate expected return for A? Yes. How will I do it? I will have to multiply 4 into 0.5. I'll have to multiply 4 into 0.5. So if I multiply 4 into 0.5, what will I get?
2.
I will get 2%. Okay. Next, if I multiply 0.4, or rather I'll make it. If I multiply 2 into 0.4, what will I get?
0.8.
0.8.
Yes, sir.
Here, how can I get more? Next, if I calculate my return of 0 into 0.1, what will I get? 0.
0.
Okay. Now, what does the formula say? I have to sum. Okay. Expected return is nothing but sum of all these. So what is the sum of all this? I have to add 2 plus 0.8 plus 0.
2.8.
2.8.
Yes, sir.
So my return, my expected return or sum of expected return is going to be 2.8. Do you agree with me? Shall I write here directly?
Yes, sir.
2.8. So this is the return that I can expect from this particular investment that I've done. Okay. Now, on similar basis, can I calculate it for security B? Can I calculate the same for security B?
Yes, sir.
Please calculate it for security B. What will be the return? It is going to be 0 multiplied by 0.5. Clear? What would be the answer? 0. Next, 3% into 0.4. What will be my return?
1.2.
1.2. Next, 3
0.3.
into 0.1.
0.3.
How much will it be?
0.3.
0.3. What is the sum of this?
1.5.
Sorry, 1.5. Sorry. Sum of this will be 1.5. Now, you have two shares with you, share A or security A and security B. You have calculated their estimated or expected return. Now, the answer for the two securities in front of you. If I ask you a question, which share would you prefer in terms of return? What would be your answer?
Share is low, sir.
Yes? Which share will you prefer?
So whichever is low, will prefer that one, sir.
No, what are you calculating? You are calculating return, right? I have not calculated the risk yet. I've just calculated the return. If I have to equate
Security A is better.
A is better, right? Because A is
Yes,
giving
sir.
much higher return than B. So preferably we should go for A. So this is the calculation as far as return is concerned. Now we also have to calculate the risk for it, right? We need to calculate the risk for it. Are you able
Yes,
to
sir.
understand?
Yes,
Getting
sir.
my logic here? You're getting my point here?
Yes, sir.
Any doubts in understanding this?
No, sir.
Sure?
Yes, sir.
Okay, now I'm just going to copy this. Okay, I'll just making two slides here. I will keep the top table only for security A and I'll keep the below table only for security B. Okay, this is for only our understanding purpose. Clear? Why I'm doing this is because I have to calculate my standard deviation now. Now for security A, this is my overall expected return, that is 2.5. Remember the formula? Remember I had told you this particular formula? I told you this particular formula. So here we have to find out, do we have probability? Yes, do we have probability? Do we have the individual return of the shares? We do have individual return of the shares. Do we have expected return? We just calculated as 2.8 for A and 1.5 for B. Okay, so we have expected return. Now using this data, we have to find out the variance and standard deviation. So basically we have to find out variance and standard deviation for this particular data. Can you do this? What will come here? What will you write down here? What table will you write down here? Or what would be the heading for this particular table? Any idea?
So can you please show the formula slide again, sir?
Okay, I'll do it. I'll do it. Remember this?
So it will be R minus ER.
Just give me a minute. Yeah, I think the formula is clear now. You're able to see it, all of you. Can you calculate these values and quickly tell me what is the standard deviation for security A and what is the standard deviation for security B?
Yes, sir.
Yeah, please do it. Sorry. Okay, let us start calculating. What will it be? 2 minus 2.8 is how much?
0.8.
Minus 0.8, right? Are you getting this?
Yes, sir.
The answer is
So here we have to deduct return from expected return, right, sir?
yeah. Sorry.
It will be 4 minus 2.
Shall I remove this because I am getting confused otherwise. Now it's clear. 4 minus 2.8. How much is it? Is it 1.2?
So we have to deduct summation of expected return.
Yeah, this is the expected return, right?
Yes, sir. But when we see the subsequent return, sir, it is 2, right, sir? For 4, it is 2. For 2, it is 0.8.
No.
So I asked, sir.
I'm running out of time.
So then here we have to take summation of expected return.
This example I wanted to show you. Sun Pharma Limited. Can you just do this? I sincerely hope your college starts because it is becoming difficult for me to teach on this particular system. I have to keep on constantly solving, and now sums are going to increase like anything. you able to hear me?
Yes, sir. So then the formula will change, no, sir? Return minus that expected return will be summation of ER.
What happened?
Sir, you have written that expected return ER, sir. Then it will be 2. But you are taking that summation of ER, 2.8. Then formula will change, sir.
I'm not getting it. What are you saying?
Sir, you are taking that summation of ER, sir, 2.8.
Okay.
Then the formula will change, no, sir?
Why?
Because it is summation of ER. ER means it's only 2.
No, this is the probability of return that you can expect,
Yes, sir.
right?
Yes, sir.
So okay,
Yes.
I got you. You are saying I know what you're saying. You are saying that summation. Why we should take this?
Yes, sir. Because particular we have 2 for 0.5 probability, and for 0.4 probability we have 0.8.
Okay. Got
So
it.
we have to yes, sir.
Okay, I got it. 1 minute, I'll tell you.
Yes, sir.
Okay. I came to know this. Rohin, this is your doubt, right?
Yes,
Why
sir.
we should take 2.8?
Ye- Yes, sir.
Okay. See, what is this 2.8?
It is the summation of ER, sir. Total of ER.
It is a total of. So, in other words, this is expected return, right? Sorry.
Yes, sir.
This is expected return, right?
Yes, sir. Total expected return.
I'll tell you what is your confusion. Your confusion is why we should take sum of it, right? Ideally, you should
Yes,
have
sir.
taken
Because
mean
in
of this. Ideally,
yes, sir. Yes, sir.
when will you take the mean?
For individual calculation, sir.
No, but when will you take the mean? You will take the mean only when there are n number of observations, right?
Yes, sir.
Do you have n number of observations?
No, sir. No. Only 3.
No, these are not observations. These are probabilities. I know what is your confusion, Rohin. You are getting confused between observations, that is number of times a particular data is happening, and your probability. Okay.
Yes, sir. Yes, sir.
See, please understand, that is what I told you in the first class. In fact, I also got confused. Probability is all these returns can happen in the next year only. So,
Yes, sir.
what does this mean? I will either get 4%, there is a 50% chance that I will get 4%. Okay, there is a 40% chance that I will get 2%, and there is
2%.
10%, there is 10% chance that I will get 0. Means what? Either I will get 4%, or I will get 2%, or I will not get anything.
Yes, sir.
It is not summation of all this. I'm not going to get all this. I will get any one of these possibilities. Rohin, are you getting confused?
Yes, sir. No, sir. I got it now, sir.
Okay,
So
now
the
tell me
doubt here is,
what is it?
so the doubt here is, here you have written R minus just expected return, right, sir? So what we thought that the expected return for the subsequent return, for example, initially it is,
You thought this
so
is,
it is 2 for 4.
I came to know, Rashmi. You thought this should ER should be 2. Next time ER
Yes,
should
sir.
be 0.8. No,
Yes, sir.
no. This is your ER.
So, but in formula, it is just expected return. No, it is not summation of expected return.
Again, I'm telling you, please understand. Expected return means you can expect this combination in the next 1 year. This is your combination.
Yes, sir.
So, okay, practically you do one thing. I'll clear your confusion again later because we're running out of time. You take this value and solve it. We'll first
Yes.
calculate standard deviation.
Yes, sir. Yes, sir.
Quickly, because we have less than a minute. I want to do this, just finish off this problem first.